This is The Money Show. Now, the Meet Your Fund Manager segment on this show has been an opportunity for you, the investor, to listen to the people that manage the funds, the mutual funds that you invest in, to learn about their philosophy, to learn about their strategy, and how they're reading the tea leaves, what they expect to happen in the medium term to the long term. My guest today is Meeta Shetty, a senior research analyst and fund manager at Tata Mutual Fund. She manages Tata India Pharma and Healthcare Fund and the Tata Digital India Fund. Thank you so much, Meeta, for taking the time. Pleasure speaking with you. I want to start by talking about the funds that you manage, the pharma and the IT funds, two sectors that are looking like they're India's strengths and likely to be the case for the several years to follow. What is the philosophy that you follow in these two funds?
Hi, Alex. Thank you for having me. So, yes, I think if I have to talk about the philosophy, there's this one broad framework that I work with. One is that, I try to have a healthy mix of, compounders as well as alpha generating opportunities. So when I say compounders, I basically mean companies which will keep growing 10 to 15% year after year, and it will keep compounding at a regular pace for years to come. And then there will be the other side, which is the alpha generating opportunities, where there will not only be a growth which is led by some turnaround or some cyclical changes or a strategy change. So it will not only drive growth, but it will also kind of give us some re-rating in terms of the value. And that is where alpha will be generated in the portfolio. Now, when it comes to the mix of this, there can be times where the portfolio might be skewed towards compounders versus alpha, depending on how the outlook or the valuation at that point of time is for both the sectors that I manage.
Okay, we'll get into some of the more detailed points, but first, it's broadly been described, pharma and IT, by a lot of people as defensive. And I think that the thinking and the rationale behind that is that they get affected less and they have less seasonality associated with them. Would you agree with that? There are people that are arguing against that now, especially with regard to the IT space.
Yeah. So starting with IT, right? So I think that IT has been perceived as defensive, and as I'm seeing the sector with time, it looks more defensive to me, because the way sector is evolving, and especially given the way it actually showcases strength during the pandemic times, practically functioning without the technology was just impossible. So it's actually more looking like defensive to me. And also, if you look at any enterprise today, right? So technology is the backbone for not only functioning seamlessly, but also driving revenues, also getting cost efficiencies. So it's in every leg of an enterprise today. So I think that as time is going towards more digitization, as world is moving towards more digitization, IT is definitely creating a lot of backbone for itself, and with time it's actually getting more defensive. But as you correctly said, some may argue that technology can be also cyclical, given that during economic downturns there can be cost cuts around the newer tech initiatives, which probably an enterprise is looking to do. But I think that that also is irrelevant now today, because as I said, during the pandemic times, we've seen that companies have actually gone ahead and spent more on technology to remain more relevant to the current times. So I think with time, it's actually becoming more defensive. Coming to the pharma sector, I think pharma has certain buckets of its which are very defensive in nature, like the domestic pharma market, which is more like a cost-side FMCG sector, and it has steady levers of growth. And we've seen during economic downturns, or even during the pandemic, actually, wherein the sector was very resilient. So I think that segment remains more like a defensive. But then also you have exports, which will have its own cyclicality. We have seen the sector going through its own ups and downs, purely led by the US export cyclicality. So I think that certain segments of the pharma sector will be classified as defensives, but not the entire sector.
Meeta, let's talk about the IT space, and we'll get to pharma eventually. But the IT space, you mentioned a lot of companies started spending, companies, governments both started spending a lot more during the pandemic as people had to adapt to the changing scenario. And there is clearly a shift in terms of what is being seen. The demand is very clearly visible. A lot of these IT companies have their order books swelling at a very rapid pace. Attrition is something that they're all contending with. I look at your portfolio, you have a very substantial allocation towards the frontline IT companies. Infy, TCS, Tech Mahindra, HCL Tech, about half of your net assets towards this. Is that going to change in the future, do you think? A lot of people talking about software as a service as a great opportunity.
So, Alex, if you look at our portfolio, we were more skewed towards larger names. If I have to look a year back or slightly more behind, and we actually then started widening the portfolio towards more large and small names. Mid and small names, and that was clearly because we were seeing a lot of opportunities in the wider space. That was clearly driven by the higher spending, which you also alluded to. So I think that we've more widened versus what we used to be in the past. And as I'm seeing the demand right now, at least the if I look at the Gartner estimates or if I look at the management commentaries, and the kind of spend that we are seeing from the large enterprises outside, clearly all of this points out towards a decent demand visibility, at least for the next couple of years. So we see broader demand opportunities across the breadth. While you're right when you are pointing towards attrition, and we've seen attrition inch up for most companies this quarter, until so far at least. But there's also something else which was clearly a surprise, and I think the way these companies have shown their strength in terms of their margin, despite the supply side challenges. So I think that if growth continues to remain decent, there is the strong margin defense as well, which is clearly showcased this time around. Coming to the SaaS opportunities, I think yes, there are a lot of growth levers for the SaaS opportunities, and clearly this is the area which will gain a lot of traction with time. But at the same time, when I look at the cloud penetration of the workloads, which still sits at about 20-25%, whereas there's still a lot on-prem, which is to go to cloud in the next maybe a 3 to 4 year time frame. And these larger IT services companies will clearly gain of this, and they are the enablers. So I see growth opportunities for them as well. So I think both the buckets actually look pretty interesting, and we will keep evaluating opportunities based on, as I said, the outlook and the valuation. But I see strength or the growth outlook being good for both of these buckets currently.
Meeta, do stay with us. We're slipping into a short commercial break, but I want to ask you about the pharma fund and growth opportunities available in new age companies, and that will come up in just a short while. Viewers, do stay tuned. Welcome back. This is The Money Show, and we are speaking to Meeta Shetty, who's the Senior Research Analyst and Fund Manager at Tata Mutual Fund. She manages the Tata India Pharma and Healthcare Fund and the Tata Digital India Fund. Meeta, I wanted to ask you about the pharma space next. And clearly a lot of opportunities here. So a couple of questions. One, the headwinds that a lot of companies have had to go up against time and again over the last several years, are they likely to crop up again? You mentioned them in the form of exports to the US. Is that something investors need to be wary of? And the second thing, of course, is the API space. A lot of people excited about it. It's not necessarily something new, but I think a lot of focus has been given to it in the recent past. Do you see value there?
So Yes, I think that on the the US side, there have been challenges, but then at the same time, that's the largest market that we export outside, and we also have, in terms of the the capabilities, if I have to say, the largest US FDA plants outside US actually sit out of in India. So clearly, we have the capability and we have the technical expertise for that, for serving the largest market. But certain, large base and certain regulatory headwinds actually led to some bit of challenges in the past. Even if I look at the near term, the last quarter actually did show some, some softening because of the U.S. Pricing pressure getting a little more aggravated. So there are challenges in the US, but as I said, the market is broad and huge, and we have the capabilities and the expertise. So I think there will be pockets of disappointments, but from a 2 to 3 year runway, there will be opportunities as well. And I think that segment will have its own challenges, but at a broader level, it should continue to do well. Plus, you also have to look at it in context of the domestic and the other export segments, which I think are looking fairly good. In fact, domestic, as I said, that it remains a very steady growth market. So at a holistic level, the pharma actually looks fairly okay to me. Coming to the API segment, just in the past, and I think even the recent power issues in China are throwing up some challenges for this space in the near term. But I think over a longer run, API space will continue to remain attractive.
Meeta, would you say, particularly if you look at the IT sector, that investors may have gotten just a tad bit spoilt based on the performance over the last couple of years? Maybe if you stretch that to 3 years, and you're not necessarily going to see the kind of gains that we've seen over the last 3 years. Is there a requirement to temper expectations, do you think?
So, Alex, I think yes, what you're saying is true. If I'm looking at the current valuations on an EV EBITDA, the sector would be close to about 17, 18 times. Even on PE ratios, we are fairly high. We are closer to two standard deviations higher now. So yes, the valuations have run ahead of time, and they're actually probably discounting the growth a little more in advance. But as I said, there's a lot more to do on the ground as far as the tech is concerned, at global level, at enterprise levels across the world, and the growth which we were earlier pegging the IT service market growth at a global level, which was earlier pegged at about 4% now probably is pegged at about between 7 to 8% or so. And at least 2 to 3 years visibility remains strong. So I think in terms of growth, yes, there is good visibility, but on the valuations, yes, there are some pockets which are actually getting a more frothy. So there can be some pockets which will kind of see some mean reversion kind of thing. So yes, very difficult to comment on the returns, but I think that the kind of returns we have seen, I don't rule out of a near-term consolidation or a correction for that matter. But over a medium to long term, I think that given the growth visibility, the sector should continue to show decent growth in terms of both revenue and profitability.
Meeta, quick last word. We're running out of time, but I still want to ask you this question. A lot of new age companies coming up in both the tech space as well as in the pharma healthcare space. Some companies that are marrying the two, but not necessarily companies that are profitable, at least initially. Some of these companies becoming available for investors to look at and will be hitting the capital markets. What's your opinion? Will you consider investing in these companies?
So I think, see, this is a very interesting space. Actually, we're just starting to see these platforms and these companies kind of, gain traction and build their average customers on a monthly or a daily basis. And there's a lot of headroom for growth for these companies. Yes, currently they will be burning cash, but I think all these companies will largely be asset light and over the longer run turning into a good ROC companies or ROE companies. is not completely out of question. But yes, currently from a near to maybe medium term, one has to be extremely cautious, given that the space is still evolving and the valuations obviously are looking very rich right now. So one has to be extremely cautious. But I think there will be clear winners which will emerge out of these companies from a medium to long term horizon. But again, one has to be extremely cautious given that the valuations wherever they are pegged at currently.
Meeta, pleasure speaking with you. Thank you so much for taking the time. This has been an insightful conversation.
Thank you, Andy.
All right, on that note, we're slipping to a short break once again, but on the other side, we speak about the place that you can escape to. It's in the Himalayas. Stay tuned.